Hey everyone, Couch Investor back to another video for today. So breaking news, something we haven't seen in a long time. What am I talking about? Well, Teladoc is actually up after reporting earnings. What do you know? I think we should frame this moment. At the time of making this video, the stock is up around 7%. It beats on earnings per share and revenue. We're going to have a look at all of those numbers. I'm going to share my thoughts at the end of this video. If you still own any shares, do let me know down in the comments below. Like and subscribe if you have not. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment, or go to full.com/couchinvestor. So, Teladoc. Revenue grew 17% year over year to $611 million. Now, revenue estimates were $608.9 million. And according to the company's outlook, which I think is a bit more accurate, it came just above their midpoint. If we look at adjusted EBITDA, that's down 24% year over year to $51.2 million. But that's significantly more than what the company was estimating. So they said that would come between $35 and $45 million. So quite a nice beat there. Now, if we look at access fee revenue, that grew 20% year over year to $540 million. Visit fee revenue grew just 5% to $66 million. And then if we look at US and international revenue, we can still see that the US is still growing quite nicely compared to, well, if you look at international revenue, that grew the same year over year. Both of them grew 17% year over year. US revenue grew 17% to $534 million. And internationally, that grew 17% year over year to $77 million. As for US paid members, that's now at 57.8 million and also above their own outlook. They were expecting between 55.5 and 56.5 million members. So they beat on that. Average US revenue per member, that's now, well, $2.61. Obviously, year over year, it has increased by 21 cents, but quarter over quarter, just by 1 cent. So at least it's not down, but obviously as the market, well, hopefully turns in the near future, we will see this increasing because, well, the whole care package should be appealing. And especially if you look at these numbers here, unique chronic care members, that's actually down quarter over quarter. Yes, it's up year over year, but that's down quarter over quarter. Hopefully they'll mention something during the earnings call. And actually, with regards to visit fee, as you can see here, yes, it grew year over year, but it has been going down since Q4. Q4 was 69, then Q1 68, then Q2 67, and now we're 66. Maybe Q4 will be 65. Hopefully it will be more, but yeah, it's something to keep an eye on. So another mixed result here. So visits came at 4.5-ish million. They were expecting 4.8 to 5. So quite a miss there. Utilization is also down quarter over quarter. It's up 1.3% year over year. Platform enabled session is up year over year a bit, but it's down quarter over quarter. As for Livongo member data points, well, that keeps on increasing. Now, yes, it's nice that it keeps on increasing, but that should help the offering. And I think it should, in the long term, well, affect all the other numbers that are trending down unless their sales teams are not that great. But we do have some better news here, and that's gross margin and adjusted gross margin. So we can see that that is again trending up for the second quarter in a row. Q1 was that complete disaster. You all remember that. They said, oh, we're going to go up, and then suddenly the next quarter it trends down. GAAP gross margin and adjusted gross margin. Now, since then, it has been going up for 2 consecutive quarters. It's also up year over year. So great on that side. Same thing can be said here on adjusted EBITDA and adjusted EBITDA margin. Obviously, it's down year over year, but quarter over quarter, that has improved as well. And that's something I'd like to see continue. Now, I say I'd like to see it continue, but if I do trust management, which they haven't gained my trust back yet, but they do expect this to continue. Let's see what happens in the coming quarters. They're still not out of the woods yet, but it is already a second quarter where things are slowly improving. As for cash equivalents, and short-term investments, that's reached $900 million. That's a little bit more than the last number we got, which was $884 million. As for convertible and long-term debt on balance sheet, that sits at $1.53 billion, same number as before. Operating cash flow year to date, $124 million, which is double the amount from the last quarter, which was $61 million. And as for CapEx and capitalized software development cost, year to date 2022, that sits at $119 million, which is also more than last quarter, which was $76 million. Now, as for outlook for Q4, they expect to grow year over year between 13 and 15%. As for net loss per share, they expect it to be, negative 40 cents to negative 10 cents. If that can reach 10 cents, I'd be extremely happy. Adjusted EBITDA between $88 and $98 million, which is quite a nice increase between 31 and 45%. US paid members to be between 57 and 58 million, and then total visits to grow 7 to 11%. That's obviously a bit lower than what they were expecting for this quarter, but this quarter they missed, so maybe they adjusted accordingly. Don't forget, we're going into the winter months, so maybe more people will be inclined to use these services. Now, as for the fiscal year, we do have some changes there. So now they expect revenue to grow 18.5% at the midpoint year over year, which is, down from their previous quarter. They did expect to grow between 18 and 23%. As for net loss per share, that didn't change that much. Obviously, this is a huge number because, of the goodwill impairment charge. Adjusted EBITDA to be between $240 to $250 million. Previously, they were expecting on the high end $265 million. So a bit of a change there again. Could be because of the current macroeconomic environment. Then US paid members, same as in Q4, but a bit more than their previous guidance. And as for total visits, 18.4 to 18.6 million, which is a bit less than their previous guidance, but again, to be expected after everything we've seen here. And as for the expenses, yes, revenue has grown year over year, but expenses as well. Advertising and marketing, that's up year over year. Sales is actually down year over year, but technology and development, that's up. General and administrative, that's up as well. But on a good note, we can see that stock-based compensation is trending down. It's actually down quite nicely year over year. And now before I conclude this video, let's have a quick look at the charts. So the red line is the 20-day moving average, the green line is 50, and then the blue one is the 200. Now, as you can see, if we zoom in, you can see that it's trying to go over that 51 right now. It has been a bit rejected. As for the MACD, it has been positive for quite a while. RSI is also improving, and of course, it will improve tomorrow when the market opens, unless management screws it up during the earnings call. But right now, it's still up 7% at the time of making this video. So we might see it go over that 50-day moving average tomorrow. Let's see if that can hold. So overall, to conclude, a good quarter from the company. Again, they're not out of the woods yet, far from it, but a good step in the right direction. Now, obviously, do share your thoughts down in the comments below. It's still in my portfolio. It's still super, super tiny position. Yes, I'm down a lot. As most of us are, I believe, but I do believe that it has a great product, but it needs execution. Let's see what happens in the coming quarters. Right now, I do not plan to add anything, just holding and see what happens. So do share your game plan down in the comments below. If you like this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I see you all in the next one. Bye-bye.